Topic 2, deductions. You will remember in Topic 1 that in order to calculate taxable income, we started with assessable income and reduced assessable income by allowable deductions. In this topic, we are going to look at those allowable deductions. This is probably the most difficult topic because you really have to start to think in this topic about how we link expenses to income. And I'll come to that in a bit more detail later on. When we did Topic 1, at the end of the day, you'll realise that income, as far as we take it, is fairly limited. It's a salary, an allowance, interest, dividends, business income. And anybody who earns a salary is going to include it in assessable income. But in deductions, what is deductible to one taxpayer isn't necessarily deductible to another taxpayer. And so you have to start to learn to think. And the best advice I can give you is pretend you are the taxpayer. And if you were in this position, you would obviously want to maximise your deductions so that you paid as little tax as possible. When I go through this in class with my students, I sometimes think they all want to go off and work for the tax office because whatever I put forward as an expense, most students say, oh, that's not deductible. So put yourself in the position, this is my tax return that I'm doing. I would like to minimise my taxable income and try and find the link between the expense and the earning of the income. So you really have to start thinking in this topic. So what we're going to do here, we're going to look at the general deduction section, which is 8-1. Then we're going to look at the exemptions or the exclusions from the general section, and then we look at section 25, which specifically allows deductions, section 26 and a few other sections which either deny or restrict deductions. And then we come, in that are some miscellaneous things like gifts and entertainment. And then we'll go on and look at carry forward losses and trading stock. The main section that we're going to look at, and this is the section that you really need to understand, is section 8-1. And while I normally say to my students, don't memorise this section, because you always want to be able to go back into this section and think about it and say, oh, first limb, this is my situation, how does it apply? And so if you can memorise it, you don't have to keep going back into the Act itself. Section 8-1 has 2 limbs in it. The first limb applies to non-business income. So non-business income would mean the income earned by way of salary, interest, rent, dividends. And the second limb applies to business income. So you need to be aware of those 2 limbs because there's a slight difference between them. The first limb says that you can deduct from your assessable income any loss or outgoing to the extent it is incurred in gaining or producing your assessable income. So you can see it only talks about assessable income, it doesn't talk about business income. The second limb talks about losses or outgoings. Now this is the difference, necessarily incurred in carrying on a business to produce your assessable income. Necessarily incurred. So it's a wider definition. So you may in a business have to advertise and maybe no one pays any attention to your advertisement, but it's still a necessarily incurred expense in carrying on your business. Now there are a few general things you need to understand. And these are all detailed for you in your Master Tax Guide, and it's well worth going back and having a read of these sections, or of these paragraphs in the MTG. To be deductible, the expense doesn't have to relate to the income of the current year. So it may be that you incur an expense in the current year, but the income was earned earlier, or the income may be earned in a later year. The classic example of this is something like loss of income insurance. A taxpayer may pay and deduct loss of income insurance for a number of years, and in fact may never call upon that source of income. But nonetheless, because it leads or could lead to income in a future year, it is deductible in the current year. You can also have a situation in which the business finished in an earlier year, but there are still expenses which relate to the carrying on of that business, and they can also be deducted. What I'd like you to do now, if you're at home looking at this or listening to this, take a minute, stop the tape after this, and think about the expenses that 4 different types of taxpayers would deduct or would be able to deduct. The first one would be an employee teacher. What expenses would an employee teacher be able to deduct? You might want to think about teachers who teach different sorts of subjects as well. Does that make a difference to what they can claim? What about someone involved in an illegal business? And because of La Rosa's case that we talked about in topic 1, what about if it was a grower and seller of illegal drugs? Rental property owners and a restaurant owner. Have a think about the different sorts of expenses that they would incur. And you'll see that while some expenses are the same, so they may all have a computer and buy paper and toner and things like that for the computer, they will have very different expenses. So the owner of the restaurant would have wages and food. The teacher, if it was a primary school teacher, could be buying little things like gold stars and stamps and perhaps small prizes to give the students to encourage them. And, the drug dealer would obviously be buying the drugs or growing the drugs, in which case you would have all the expenses in relation to that. And the rental property owner could well be paying rates and taxes and interest on a loan to buy the property, and may well be repairing the property as well. So you can see that while there might be similar expenses, there are also very different expenses. So no longer can we say all interest is deductible or all interest isn't deductible, because some of it will be deductible and some of it won't be, depending on the taxpayer. So you have to start saying, who is my taxpayer? How does my taxpayer earn his or her or its income? And is this expense incurred, or if it's a business, necessarily incurred in earning that income? And if you can find the link or the nexus, as it's called, then you can deduct it. The next words that are important in this section are the words "to the extent." And what this means is that a taxpayer is able to deduct only that percentage of the expenditure which relates to earning assessable income. So, for example, with motor vehicle expenses, if a salaried employee uses his or her car to travel 80% for private use and 20% for work-related use, then 20% can be deducted because the section says it's deductible to the extent it's incurred in earning the assessable income. So that's very important because it allows this apportionment between the income related and the non-income related expenditure. The next word that's really important is the word incurred. And the courts have held that incurred means totally committed to the payment. It doesn't mean actually having paid it, but it means that the taxpayer is totally committed. So if the taxpayer hasn't paid it, obviously if it's been paid, it's been incurred, but if the taxpayer hasn't paid, but is completely committed to the payment, then it will be deductible. Now, this would be situations where someone buys something on account and pays for it at the end of the month or after the end of the month. Now, if the month happened to be June, which is the end of our financial year, and the payment was made in July, it would still be incurred at the 30th of June. And therefore, it would be deductible in the current year, not in the following year when it's actually paid. So you really need to come to terms with this issue of incurred, of being totally committed to a payment, even though the payment hasn't yet been made. So I've got an example for you where supplies are delivered to a client at just before the 30th of June, and they're not paid for till, say, the 10th of July. They would be deductible in the current year, not in the future year when they're actually paid. You first need to understand what we talked about previously in 8-1, and you really need to understand it well, because from there we move to 8-2, and 8-2 covers the exclusions. So even though it may be incurred in earning assessable income, this section will deny a deduction. So 8-1 subsection 2 says, however, you cannot deduct a loss or outgoing to the extent it is a loss or outgoing of capital or of a capital nature, or a loss or outgoing of a private or domestic nature, or is incurred in gaining or producing exempt income, or a provision of this Act prevents you from deducting it. So it's very specific. It says if it's this or this or this, you cannot deduct it. Now you have to start developing a way of thinking your way through these issues. So when you look at an expense, you're going to start by saying, is it deductible under 8-1? Is it incurred in earning assessable income, necessarily incurred in carrying on a business? Then the answer to that may be yes. If it is, then you have to say, but hold on, is it capital, private, domestic, incurred in earning exempt income, or is there a section that specifically excludes it? And interestingly enough, if it doesn't fall into 8-1, you then have to say, well, can I deduct it under section 25, which we'll look at shortly. So it's a way of thinking that you have to develop so that you can work your way through the problems. So the first one, and this is a really important one you need to understand, is capital expenses. Now, the best way to think about a capital expense is that a capital expense gives you a long-term advantage. So the best way to compare it is to think about buying a property to use or renting a property to use to carry on your business. Renting gives you a short-term advantage. You pay this month's rent, you can use it for a month. You pay the next month's rent, you can use it for another month. It's a very short-term advantage. If you stop paying your rent, your landlord will evict you. So the benefit of rent is a short-term benefit. Buying the property, buying the building, is a capital expense and it gives you a long-term benefit. Now, it doesn't necessarily have to be a long-term benefit of the rest of your life, but it has to be a sizable amount of time. So if you compare rent to buying, you can see the difference between a capital expense and a revenue or an ongoing expense. Now, you really need to understand this because in topic 3, when we look at capital gains tax, repairs will fit into element 3 or element 4. The difference being one is an ongoing repair and one is a capital repair. And significant differences arise depending on which element you put it into. So before we get to topic 3 and you struggle with it there, come to grips with the concept of a capital expense here in topic 2. Later, when we look at uniform capital allowances and so on, the capital expenditure incurred in buying assets will lead to their depreciation under topic 4. So you really need to understand this issue. So remember, capital expenses give you a long-term benefit. You might want to think about our particular taxpayers we looked at before and work out what capital expenses they might be incurring as well. Now we come to private or domestic expenses. Private expenses relate to the taxpayer himself or herself, and domestic expenses relate to the home of the taxpayer. Before I go any further, in your exam papers that you'll be doing, if you exclude an item, you need to give a reason. And so, for example, if my question said that the taxpayer had bought a building, it would be necessary for you to write purchase of building dash capital. So get used to, this is a capital expense, this is a private expense, this is a domestic expense. You can use, we don't mind if you use private or domestic interchangeably, but certainly make sure you understand the difference between a capital expense and a private expense. So the first one we're going to look at is travel expenses. Now the courts have said that the cost of getting from home to work and back home again is a private expense because it is your choice to live wherever it is you live, and the fact that you then have to pay money to get to work is a private expense. It's caused by your choice in living where you live. Now, there are a few adjustments to this rule. Firstly, if a taxpayer doesn't have a fixed place of work, so if they have to go to a number of different places, then that taxpayer can claim his or her travel expenses. So there was a case where a music teacher taught at about 3 or 4 schools, and on Monday she went to school number 1 and then she went to school number 2 partway through the day, and then she might come home that evening. But the second day she might go to school number 3 and then back to school 1 and then come home. So she had no fixed place of work, and therefore her travel expenses were fully deductible. If a taxpayer has to carry bulky equipment to work, then the cost of travelling to and from work is deductible. So you'll see a lot of tradespeople who can deduct their travel expenses because they have to have a van with all their tools and their materials in it, so they can deduct their costs. And if you travel from one place of earning income to another place of earning income, that travel is also deductible. So if you have someone who travels to their normal place of work and then travels from there to a second job, then that is deductible. that second trip. Now, make sure you understand this because we're going to do self-education a bit later, and that rule comes in and affects us in self-education. Under section 25(100), you can claim the cost of travelling between two places of work providing one is not the taxpayer's home. So you can read about that in your Master Tax Guide. The next private expense is childminding. The cost of having your children looked after in order for you to be able to go to work is a private expense. This has been tested a number of times before the courts, and in each case it's been found to be a private expense. The rationale is it has nothing to do with how you carry out your duties. So it's an expense incurred before you can earn your income, and it's a private expense. The next private expense is one that causes a lot of problems with students, and it's the issue of home expenses. We have two situations. In one, a taxpayer has a place of work, but chooses to work from home as well. And then the second situation is that the taxpayer's home is the place of work. Now, different expenses are allowable to each of them. If you understand the difference, it will make applying this much easier. The first one we'll call home study expenses. This is where you have a place of work. Now, the best example I can give you is my situation. I have an office at Curtin. I have a desk, a chair, bookshelves, a telephone, access to a fax machine, a computer, a printer. Everything I need to do my job is in my office at Curtin. However, I also choose to work from home. As you will discover, I will be answering your discussion board questions, your emails, in the evenings and on weekends. Now, I do this from my home study. My home study has a desk, a chair, bookshelves, a computer, a printer, internet access. Now, the question is, if I said that my home office was 1/10 of my home, can I deduct 1/10 of my mortgage interest if I'm buying my house, or 1/10 of my rent if I'm renting? If I'm buying the house, can I claim 1/10 of my rates and taxes? And the courts have said, no, I can't. I cannot claim a percentage of my occupancy costs. What does it cost me to occupy the house? I have to pay in some way for the house by way of interest on a loan to buy it or rent if I'm renting. So I cannot claim my occupancy costs. What I can claim, and sorry, if I go back, the courts have said that this is essentially my home. This is where I live. And I have a place of work. So it's only my choice to work from home. Therefore, my occupancy costs aren't deductible. However, what I can claim are the extra costs which arise in my home because I do work from home. So if I can obviously depreciate my desk and chair and bookshelves and that sort of thing. In addition, I can claim a percentage of my electricity and heating and cooling. Now, the way we tackle it in this unit is we will just say to you that the room occupies X percentage of the house, and you will apply that percentage to such things as the electricity, the heating and cooling. So that is if home is just where you choose to work, but you have an office elsewhere. The next situation is where home is your place of work. So if we think about the music teacher who went from one school to another, and she had no place of work, so she may well have had an office at home in which she prepared her lecture plans, in which she did her marking, and did whatever else she had to do. Now, home, if it's your place of work, your home office, then you can deduct a percentage of your occupancy costs. So you can then deduct, if the room was 1/10 of the house, 10% of the rent, or 10% of the interest, 10% of the rates and taxes. And you can also claim 10% of your running costs. So if home is your place of work, so if someone's running a business from home, then they can deduct a percentage of occupancy and running costs. If home is only where you choose to work and you have another place of work, then you can only deduct a percentage of the running costs. Now, the distinction is important because, again, in capital gains tax, if you were able to deduct some of the costs of occupancy, so your mortgage, rates and taxes, then that same percentage of your capital gain will become assessable when you sell your home. So you need to understand the difference, because not only does it affect your deduction here, but it's going to affect your capital gain when we come to do capital gains tax. The third exclusion is deductions incurred in earning exempt income. And if you think about this, it makes sense. If the income is exempt, then you can't claim the deductions incurred in earning that income. And lastly, anything that's specifically denied. So when we come to section 26 and 32, 34, you may find that even though it's an expense incurred in earning income, there is a specific section that says, no, you can't deduct this amount. Let's now look at section 25. And section 25 specifically allows you to deduct certain expenses. So they may not be deductible under 8-1, but section 25 says, yes, you can deduct this. The first one is 25(5) for tax-related expenses. Now, if you think about it, as an employee, paying to have your tax return prepared by a tax agent has nothing to do with earning your income. So that cost would not be deductible, but section 25 allows you to deduct it. Note, of course, it can't be a capital expense, and it can't be for the actual tax payment itself. If it's daily, just ongoing advice on running your business and stuff, then of course that would be deductible under 8-1. The next section, and this is another really important section because it's going to affect us in topic 2 and greatly in topic 3. And students just don't come to grips with it in topic 2 and then make a huge mess of capital gains tax later on. Section 2510 allows a deduction or a proportion of the deduction for the cost of repairs to income-earning property or income-earning assets. So the first thing is you need to look at the section which says you can deduct expenditure you incur for repairs to premises or part of premises or a depreciating asset you held or used to produce assessable income. So it's an expense incurred in the current year. It's not capital. It's to premises or equipment used to earn income or in carrying on a business. Now, what do we mean by a repair? The word repair is not defined in the Act, so you need to go back and see what the courts have said are the criteria of a repair. And the sort of things that have come up is that a repair is a replacement or renewal of part of something. If you replace the whole thing, you haven't repaired it, you've replaced it. So we're talking here about mending leaks, repainting part of the house or the building or something like that. A repair returns something to its original condition, but it doesn't make it better than it was to start with. So what you're doing is you're saying, what did this look like when I first bought it? It was here. Now it's worn down over time, and now I'm repairing it and I'm taking it back here. But if, when you're repairing it, you make it better than it ever was, then that's not a repair, that's an improvement. You also need to actually repair the item. So there was a case where a cinema had a roof that was leaking, and in the end they decided that rather than rather than take off the roof, which meant of course they couldn't trade and then fix up the roof, what they did was they just put a whole new roof over the existing roof. And that was held not to be a repair. They didn't repair the existing roof, they bought themselves a whole new roof. So to be a repair, you have to actually fix it, you have to take it back to its original condition. And you can, of course, have a situation in which whatever used to be used, the materials are no longer in existence, and in which case you have to use something that's as close as possible to that. The next issue with repairs is this issue of initial repairs. What happens when you buy an asset? You buy a piece of equipment, you buy a building, you buy a truck. And at the time, this is the rule to remember, at the time you bought the truck or whatever it is, if it had a defect that needed repair, the cost of that repair is what we call an initial repair. And it is not deductible. It is considered to be a capital expense. Now, it's very easy to understand that rule if you say, well, obviously it's capital because if, let's say you bought a rental property and it was really run down. So the example I give my students in class is, what if you bought two rental properties next to each other? Exactly the same building, they'd been built at the same time. One was well maintained and one had not been so well maintained. Obviously the one that had been better looked after would cost you more. So let's say it cost you $200,000 to buy. The second property that was run down, maybe it only cost you $150 to buy, and then you spent $50 bringing it up to the same condition as the one next door. That $50,000 worth of repairs is what we call an initial repair, and the cost is not deductible. Now, that's really easy to understand if we're looking at two houses and you can see the difference between the two houses. That rule makes sense. But what if you paid $200,000 for both the houses? They were both equally well maintained. When you looked at them from the outside, they looked fantastic. Everything was exactly the same. 2 weeks after you buy the property, the floor collapses in one of them because the wood has been eaten by termites or white ants. Now, that damage doesn't happen in 2 weeks. It's damage that occurs over a period of time. And so even though you didn't know that that damage was in existence when you bought the property, the cost of repairing the floor is still an initial expense. So the rule is, if the need for the repair existed at the time of buying the property, then it's an initial repair and cannot be deducted. Because a repair, if you go back to the section, if I take us back, a repair, you can deduct repairs on assets used to earn assessable income. Now, the need for the repair didn't arise out of your use of the property. It's an interesting area. Some years ago, many years ago now, there was a taxpayer who bought an old property and put a uni student in to live in it at a very reduced rental and said, you can live here, the rent's really cheap, but I'm going to be working around you and fixing it up. So I'll be coming in, painting rooms and fixing up the doors and so on. In return for that, I'm giving it to you at a very low rent. And when the taxpayer put his tax return in, he said, look, I've got rental income and I've got these repairs. But the court said, no, the repairs you were fixing existed at the time you bought the property, and therefore they are initial repairs. So please understand that, because when we look at topic 3, those initial repairs become element 4 of a capital gain, of the cost base of an asset. If they are ongoing repairs, then they are element 3, and a number of different things happen because of where we position them, element 3 or element 4. So please understand the difference between these two. Section 2525 is another big section that you need to come to terms with. Now, this concerns borrowing expenses. And the first thing we need to do is we need to establish what is a borrowing expense. A borrowing expense is an expense incurred to be able to borrow money. It's not interest. Remember, interest is an ongoing expense that you're going to pay each month to the bank. These are expenses that you pay at the commencement of a loan. So what it allows us to do is it allows us to write these expenses off over a period of time. These are capital expenses. They give us a long-term benefit. They give us access to a loan for 5 years or 10 years or 20 years. Therefore, under 8-1 subsection 2, they would be excluded because they're capital. But this section says, we know they're capital, but this is how we're going to let you write them off. Now, firstly, what are borrowing expenses? Loan application fees. You go to the bank, I'd like to apply for a loan. Oh yes, fill out this form and we'll charge you $1,000 or whatever. There might be legal fees, valuation fees. If you want to borrow $1 million and secure it over your some property, the bank wants to know that the property is worth at least $1 million. So if the bank has to sell it, they want to know they can get their money back. Stamp duty. The state governments impose stamp duty on loans, and that is also a borrowing expense. Now, they're capital expenses. We can't deduct them, but we can deduct them over a period of time. So the first thing is, it talks about what is the period of the loan. And the period of the loan is basically the lowest of, or the least amount of time of the loan period, or 5 years, or whatever's left on the loan period. Now, the general rule that you can apply is that the loan period is the term of the loan or 5 years, whichever is the lesser. Remember, we don't worry about leap years in this course, so the most number of days we'll be writing off the loan is 1,825, which is 5 times 365 days in a year. An exclusion here is that if the borrowing expenses in total come to less than $100, then they're just fully deductible. So the thing about this section, and considering this section has now been in place, that the rewritten section has been in place for a long time, it still amazes me that students keep using an old way of working out the answer. The Act is very specific. Have a look, get your legislation out, get your core tax legislation out and have a look at this section, because it says the way you calculate the deduction is that you work out the remaining loan expenditure over the remaining loan period. Then you get a rate per day, and then you apply that rate per day to the number of days in the year the loan has been operating. So we need to understand two terms. What is remaining loan expenditure and what is the remaining loan period? Now, if you think about it, let's assume it's an 8-year loan, therefore we're going to write it off over 5 years because 5 is the lesser period. The remaining expenditure is in the first year is our total borrowing expenses. It's all remaining because we haven't written any of it off. Then, so let's say for argument's sake, in fact, I've got an example for you. If you took out a loan and the fees came to $1,000 and you took out the loan on the 1st of February and it was a 10-year loan, what is the remaining expenditure in the first year? In the first year, the remaining expenditure would be the $1,000. It's all still with us. What is the remaining loan period? Because it was a 10-year loan, we're going to write it off over 5 years, so 1825. So the first thing you need to know is how much of that $1,000 will we write off per day. So you divide 1,000 by 1825, and that gives us 55 cents per day. The loan ran in the current year from the 1st of February to the 30th of June. That's 150 days. So you will deduct 55 cents by 150 days, and that comes to a deduction in the current year of $83. Now, when we come to the next year, what is our remaining expenditure? We started with 1,000, we deducted 83. What is remaining? For remaining loan period, we had 1825 days. We deducted the expense for 180 days. What is our remaining loan period? Now, if you work those out, then you'll see you actually end up with, you'll still have 55 cents per day, and now you'll deduct it for 365 days. So see if you can work that out. Now, in the exam, if the loan was taken out in the previous year, we usually give you a mark for calculating that expense because that leads in to our remaining expenditure, our remaining loan period for the current year. So don't just divide by 5. Now, one of the reasons here, they've phrased it this way. What would happen if for some reason, or say they decided to pay off the loan partway into the second year, then the remaining loan period becomes that number of days in the year. And you'd find your daily rate would be much higher than 55 cents. And you'd write it off for that number of days that were left in the year. So please take care with this expense. Remember, the daily rate is in dollars and cents, but the actual deduction is in whole dollars. Section 2530 is our next section, and this covers mortgage discharge expenses. When you finalise a loan and you want to discharge your mortgage, then the bank charges you more money, and again, to the extent the loan was for income earning purposes, that percentage will be deductible. So if you only used 80% of the loan for your business and then you use 20% of the loan to go on a holiday, when you discharge the mortgage, only 80% will be deductible. The next section we're going to look at is the section for bad debts. And this, again, brings up a few rules that you have to be aware of. It says you can write off a debt or part of a debt. Sorry, you can deduct a debt that you write off as bad if it was included in assessable income of that year or an earlier income year. So a few things. You must have a debt and it must be a bad debt. Now, to be a bad debt, it means you've been trying to collect it and you can't find the people, or they won't pay, or they're having difficulty paying, and you think that you're not going to get your money back easily. The most important thing is that you actually have to write off the debt. So you might come towards the end of a financial year and say, look, these are my bad debts. These are people who haven't paid me for, say, 3 months or more. Then you have to actually write it off. So let's say you added up all your bad debts and they came to $10,000. Then you look at it, you say, well, this one I've been trying for 18 months. I've now discovered that the people have left Australia, so I know I'm never going to get my money, and that was a $2,000 debt. You write it off. So now your bad debts are only $8,000. So you have to actually write it off. You can't sit there and think, don't think I'm ever going to get this money. You have to actually write it off and say, look, I'm never going to get that money. And then the last thing is you must have previously brought that income to account as income. Because what we're doing is we're saying either earlier this year or in an earlier year, we included this money as income and we've paid tax on it. We never ever received the cash, so now we're writing off our debt. So if you meet all those requirements, then you can deduct the debt. So it must be a bad debt, we must have written it off, and it must have previously been included in income. Now, if your taxpayer is working on cash, of course this won't arise because they've never brought the income to account. On the cash basis, you only record it as income when you've received the cash. So while you might still be holding it as a bad debt, you never brought it to account as income. And so when you write it off, you don't get a deduction for it. So you only get a deduction if it was previously included as income. 2545, losses by embezzlement. So again, similarly, if it had previously been brought to account as income and then you discover that one of your employees has been stealing money, then you can deduct it. Now, if you think about all these, they make sense because what they're saying is you've previously brought them to account as income, but it turns out that they're not income, so you get the deduction to remove it. So all you're doing is bringing your taxpayer back to a zero position. 2550 concerns pensions, gratuities or retiring allowances. If you make a payment to a previous employee from a previous business or your existing business, or you pay a retiring allowance to an employee in your current business who's about to retire based on their good service and the work that they did, then that is deductible under this section. Be aware of this section because when we do losses, it's going to come back and affect how much of our losses we can deduct. Now, 2555 is a section that causes students so many problems. And what I'd like you to do is think about it rationally. Remember I said, pretend you are the taxpayer. Now, this section says, if you make a payment to an association, a professional association. If you cannot deduct that payment under 8-1, then under this section you can deduct $42. So the question I put to you is this: if this was you as a taxpayer and you had made a payment to a professional association of $500, which would you prefer to deduct? $500 under 8-1 or $42 under 2555? And obviously you would prefer the $500 deduction. So the first thing you do is you look at the payment and you say, can I find the nexus, the link between paying this expense and earning my income? And if I can, I'll deduct it under 8-1. If I can't, then I fall back into 2555 and I can only claim $42. So let's look at our example. We have a carpenter, and the carpenter makes a payment of $300 to the Australian Carpenters Association. That is fully deductible under 8-1 for the $300. But the carpenter also contributes $100 to CPA Australia. Now, we can't find the link between earning income as a carpenter and the payment to CPA Australia. Now, maybe the carpenter used to be an accountant and was a member of CPA Australia and wanted to keep up those links, but it has nothing to do with the earning of income as a carpenter, so the expense is not deductible under 8-1, so we fall back to 2555 and only claim the $42. Now, you can claim any number of subscriptions under 8-1. You're not limited to one or two. So you'll find some professional people may well be members of, 6 or 10 or even 20 professional bodies. If you can find the link to 8-1, they're all deductible under 8-1. If you can't find the link, your fallback position is 2555. And you can, of course, claim a number of $42 if you don't have the link. Section 26, amounts you cannot deduct or cannot deduct in full. Now, this section here links back to 8-1. 8-1 said, if it relates to earning income necessarily incurred in carrying on a business, it's deductible. This section says, no, we're not going to let you have a deduction for certain expenses, even if they're incurred in earning your income. The ones we're going to look at are 26.5, penalties and fines, 26.10, leave provisions, 26.20, HEX help, 26.30, relatives travel expenses, then payments to associated persons, sporting club facilities and leisure facilities. The first one is 26.5, and it prevents you claiming fines or penalties, even if they were incurred in carrying on your business. So if a fine is imposed by a court, you cannot deduct it. Similarly, 26.10, leave provisions. If you provide for leave, annual leave, long service leave, sick leave, you cannot deduct the provision. It's not an incurred expense. But when the actual leave is paid out of that provision, then it becomes deductible. That's important. It's particularly important when we do reconciliations from topic 5 onwards. So provisions are not an incurred expense and are not deductible. Section 26.20, HEX help payments. The government provides university places to students, but students have to make a contribution towards the cost of this education. This is called the Higher Education Contribution Scheme. And in respect of undergraduate positions, this payment is not deductible even if the student is studying in the course of earning income. So a classic situation, we have students who work for accounting firms or the tax office, and they're studying a Bachelor of Commerce at Curtin. Their HECS payments, as we call them, are not deductible to the students. So even though they have income, they're required to study and finish their degree, those payments are specifically made not deductible. Now remember I said that in the exam you need to comment on why something's not deductible. With these expenditure items covered by section 26, it's easier just to quote the section number. So just section 2620, excluded. That's all you need to say. Now remember, of course, that if your employer pays your HECS for you, then your employer will claim the tax deduction in full, but will pay HECS on it. I'm sorry, not HECS, fringe benefits tax, FBT on it. So, as an example, Susie pays her own HECS. It relates to earning her assessable income, but she can't claim the deduction for it. However, if we have Mike who pays $2,000 for his employee's HECS, Mike can claim a tax deduction for the HECS, but will pay FBT. So you need to... I'm sorry, my computer's just doing weird things here. So you have to realise that an employee paying his or her own HECS doesn't get the deduction. The employer who pays HECS will get the deduction, but will pay FBT on it. And a few more things we're going to look at now. The same rationale is going to apply. The next one, 2635, payments to associated persons. If a taxpayer makes an unreasonable payment to an associated person, the Commissioner will deny the unreasonable amount of the payment. Now, think here about the rationale behind this section. If you think about a family situation and you had one spouse who actually was running the business, but the other spouse had no income, and for whatever reason there was no partnership in place. One way of moving income from one spouse to the other is to make a payment for work done. In many instances, the spouse actually does work in the business, but certainly doesn't do enough work to justify being paid half the profits of the business. However, in a family situation, you would say, oh, well, my spouse works 20 hours a week in the business and I think is worth, $50 an hour or something like that. And that enables you to move income across into the other spouse's name, take advantage of the tax-free threshold, the low rate of 15% and so on. This section says you can't do that. The rule that the Commissioner applies is what would you pay an unrelated person to do the same job. Now, the rationale being, if that was my husband and I'm just paying him $50 an hour to do that work, but if I went and hired someone off the street, I would only give them the going rate as required by law of $20 an hour, then $20 an hour is the amount I can deduct. You can't argue and say, oh, but, he's worth more, whatever. It's what would you pay an unrelated person to do the same job. Now, who is an associated person? An associated person, again, look up the definition, is husband, wife, mother, father, children, brothers, sisters, their spouses, their children, associated companies and trusts and partnerships and so on. So for our purposes, we will be looking especially at this part of the course, we will be looking at payments made to a husband or a wife or parents or children. But if it's, and a spouse is either your legally married spouse or someone you are living with in a bona fide de facto relationship. Can you have a bona fide de facto relationship? Anyway, in a de facto relationship, so you're actually living with them. If it just happens to be a girlfriend or a boyfriend or a very good friend, they don't meet the definition of an associated person, and therefore you can pay them whatever you like. Now, if you're kind enough to pay your friend far more than they're worth, well, good luck to you. So do be careful with this section. Again, we will be adjusting these when we do reconciliations from topic 5 onwards. Section 26, 45 and 50, leisure facilities and sporting club subscriptions. Again, no deduction if you pay them yourself, even if they relate to earning your income. So the classic example is someone sells sails for yachts. They can't go and take out a yacht club subscription because they'll find people there to whom they can sell the sails. But if the employer pays the subscription, the employer gets the full tax deduction but will then pay FBT on providing that benefit to the employee. Now, you'll remember, as a result of the decision in La Rosa's case, La Rosa was able to deduct the money that was stolen from him. So he earned illegal money selling drugs. He had money buried in his back garden. Someone came and dug up the money and stole it. And he said, okay, if you're going to assess me on this income, then you have to allow me a tax deduction. The commissioner said, but your income is illegal. La Rosa said, you're going to assess me on it. It's a necessarily incurred expense in carrying on a business as a drug dealer. And the court said, he's right, and let him have the deduction. As a result of that case, the Act has been changed, and now, under Section 2654, if your activities are illegal and you have been convicted, you cannot also claim your expenses. So basically, if La Rosa's situation arose now, he would have been assessed on I think it was roughly $750,000 from the sales, but none of his expenses would be deductible. We finished with Section 26, and we now move to a relatively new section which is Section 40-880, and it relates to business-related expenses and the capital costs of a business. Now, this section allows a 20% deduction for 5 years for capital business-related costs which cannot be deducted or dealt with anywhere else. When this section was first incorporated into the Act, it related to what we call black hole expenditure. You know, the black holes in space that when things go into them, nothing ever comes back out again. And so it was considered with businesses that there were some expenses that you incurred, and because they were capital, you couldn't deduct them. They didn't relate to buying an asset, so you couldn't depreciate them. Because of their particular nature, they couldn't form part of your cost base of an asset, so they would eventually reduce your capital gain when you sold them. They couldn't be deducted under 8-1, and so they fell into this huge black hole, and there was no tax benefit obtained from them. So the section was incorporated into the Act, and it said, okay, what you can do is you just deduct it in 5 equal instalments. So what are these expenses? The Act says they are in relation to a business, so that's your existing business. They're in relation to a business you used to carry on, that you propose to carry on. They're expenses to liquidate a business. And you can claim all these in 5 equal instalments, so 20% per year. Now, the sort of things we would look at here would be if you had expenses before you started your business. So maybe you had to go to a lawyer, or you did a feasibility study to see if it was worth starting this business. You might start your business as a partnership or a sole trader, and you want to look into converting your business into a trust or a company. All those sort of expenses would be covered in here. It would cover expenses like the cost of trying to take over another business or defending your business from a takeover. Now, it doesn't concern the actual purchase of assets, because if they're depreciable assets, we'll depreciate them under the rest of Division 40, or if you're buying land or buildings that you're going to use to run your business, then they would form part of the cost base. So we're not looking at those sort of expenses. We're looking at these expenses to set up, to expand, to alter your business structure, takeover expenses, liquidation expenses. Now, students really struggle with this expense, and what they tend to do is they tend to get these expenses mixed up with borrowing expenses. Now, the difference is this is a straight 20% for 5 years. Borrowing expenses relate to 5 years or the term of the loan, whichever is lesser, and we work out a daily rate and then we deduct it for the number of days in that year. So in fact, borrowing expenses, if you took out your loan in June of year 1, you would only deduct 30 days, then you would have 4 full years. So you're actually now deducting over 5 years. Plus you'd have the 6th year where you wrote off the rest of the expenses, because it's 5 years in total, but they might straddle a number of tax years. Here we're just looking at a straight 5 years. So if you incurred these expenses on the 1st of June, you'd have 20% in that first year and 20% in the next 4 years, and that's the end of it. Also bear in mind the difference between a borrowing expense and a capital expense in relation to your business. So I've done an example for you on the slide, and the example says that you borrowed $100,000, your borrowing expenses were $2,000. We used the loan to buy some new equipment, and the loan commenced on 15th of May. It was to be repaid in 6 years, and we also spent on that day $35,000 defending a takeover from a competitor. So the first thing is we've got borrowing expenses, which we're going to write off over days. So 2,000 over 185 to give us $1.10 a day for 47 days is $52. The business expenses to defend the takeover are deductible under 40-880, and we just simply deduct 20%. So we've got $7,000 for that one and $52 for the borrowing expenses. So please be aware of the difference between the two. We're looking at this point now at just miscellaneous expenses, which are either deductible or deduction. The deduction is limited. And we now move to the old 1936 Act, and we look at section 51AK. Now, this section is often confused, students confuse it with 21A. But this section is looking at where a taxpayer pays for something, actually puts out money. Remember, 21A was more almost like a bartering situation where someone did a job for someone else, and instead of getting cash, that person did something or made something or gave this person something. So that was income. 21A was income. 51AK is looking at expenses. Now what it's saying here is, when you go out and you spend money to buy something for your business, now it could be an asset that you're buying or it could be materials that you use in your business. What this section is saying is, when you go to buy it, if the person who you're buying it from gives you something, says, I know you're buying $10,000 worth of materials, and that's the normal market value is $10,000. However, because I want to keep your custom, what I'll do is I'll give you a $500 something. Whatever it might be a watch, it might be a printer, it might be something. What this section says is, if that thing that you receive is used privately, so it's not used in the business, then of the $10,000 that you've paid, you are deemed to have paid $500 for this private thing that you got and $9,500 for your materials in the business. So what you do is you look at the payment that you made, and then you say, well, what did I get? In addition to the $10,000 of materials, I got a $500 watch. Now, did I give that watch to my salespeople who needed it because they had to be on time because they had a lot of clients or something, if you could make that up, right? Or let's not say a watch. Let's say a really nice $500 clock. Did you take the clock home and use it in your home, or did you use the $500 clock in your business? So you put it up in your reception area or something like that. Now, if you used it in your reception area, it was used for income earning purposes. Therefore, the full $10,000 is deductible. But if you took the clock home, then you're deemed to have spent $500 on the clock, $9,500 on your materials. Because the clock was privately used, only the $9,500 can be deducted. So please make sure that you are aware that you've kept the things separate, and you understand that some is in relation to paying for it, for the materials, and the rest is in relation to this private thing that you received. I've done another example for you. We've bought some consumables for $1,000. Here's the watch. I knew there was a watch somewhere. For $100, and you're deemed to have paid $900 for the consumables because you've taken the watch and used it privately. Once again, remember there's a difference between 21A and 51AK. And I've got another example for you where I've tried to put the two together, 21A and 51AK. So James has got a business. He's got sales of $100,000. One of his customers didn't pay him, but repaired his work vehicle, which was worth $500, and also repaired his personal vehicle for $400. So that's 21A. So James has done work, and instead of the person saying, here's the cash, the person said, I will repair 2 of your vehicles. So that's 21A. So you've got a benefit. The benefit was $900 worth of repairs, and then $500 was repairs on the work vehicle, so we can deduct that under the otherwise deductible rule, and the remainder was the benefit received. Then James bought materials worth $30,000. Supplier provided James with 2 vases worth $300 in total. James took 1 vase home, left 1 at the business premises. What is his taxable income? So stop now and do that exercise, because here we're putting those 2 sections together. You can see we've got sales of 100, we've got a 21A benefit of 900, less the otherwise deductible rule, so the benefit was 400, so that's $100,400. The materials were $300,000 to buy. Oh, sorry, $330,000. There's a non-deductible benefit of $150, the vase that was taken home. So the materials, the deduction is only $29,850, bringing our taxable income down to $70,550. We now come to gifts. In Division 30, gifts do not relate to earning our assessable income or are necessarily incurred in carrying on a business. So we have Division 30, which says that certain gifts are deductible. You'll notice the gifts need to be $2 or more in cash, and we've got general categories. Remember, a gift is exactly that. It's something you give without getting anything in return. So if instead you make a gift, if you buy a raffle ticket, it's not a donation, it's not a gift. If you send money and they give you a pen or something like that, it's not a gift. So we're talking here about just a straight gift. You'll see there are general categories: public hospitals, public benevolent institutions, education, and so on. And with political parties, there's a maximum of $1,500 which can be deducted. We now come to entertainment. Now, entertainment used to be not deductible in full. What we now have, this is in Section 32. So the first thing I suppose we should talk about, what is entertainment? It's the provision of food or entertainment by way of food or drink or accommodation or travel to provide the entertainment. Now, what the situation used to be, unless you were running a restaurant or a theatre or something, obviously you can deduct your expenses there. But beyond that, any entertainment was not deductible. The rule now is an employer can claim the cost of entertainment of his, her, or its staff, but will then pay fringe benefits tax on it. You cannot deduct entertainment of your clients. You can only deduct the entertainment of your staff. Now, when I was teaching this, when I went overseas to teach, a student said, but how can that be? Because you take your clients out to entertain them and you hope that they will then come and do business with your organisation. But because the entertainment provisions were misused many, many years ago, the rule now is no entertainment. So, but people were then entertaining, not getting the deduction, and there was no FBT. So you could entertain your staff fairly lavishly. So now, staff, the deduction is allowable for staff entertainment, but fringe benefits tax is payable. There are, of course, cases where your staff are travelling and have entertainment in the definition simply because, you know, they're having meals and things. So the way the Commissioner taxes it now is that there are a number of ways you can work out what is deductible and subject to FBT and not deductible and not subject to FBT. The rule we're going to use is the 50-50 rule. Or I will say to you in the question that the taxpayers kept a record and 40% relates to staff, so that 40% will be deductible and subject to FBT, and the 60% which relates to clients will not be deductible. So just follow the information that I give you in the question.